Ever stared at a dense financial report, just wishing someone could, cut through the noise and tell you what really matters?
Maybe pull out a surprising detail or two.
Exactly. Well, that's what we do here. Welcome to The Deep Dive, your shortcut to getting smart on complex stuff.
And today, we're jumping right in.
We're tackling the unaudited financial results of AU Small Finance Bank. This is for the quarter ending June 30th, 2025.
And look, this isn't just about crunching numbers.
No way. It's about understanding what's driving those numbers, the strategic thinking behind them, and, well, what it means for a bank that calls itself a forever bank.
We'll hit the highlights, the financials, asset quality.
And some, honestly, quite surprising things they're doing with tech and community work, stuff you might not expect.
And just so you know where we're getting this from, our sources are the official board meeting docs, their investor presentation, and the press release.
All fresh off the press, issued July 19th, 2025. So it's direct from the bank itself.
No filter. Let's get into it.
Okay, so setting the scene, Q1 FY26, the bank described the environment as seasonally muted and subdued macro. What does that actually mean for a bank day to day?
Well, usually muted means things slow down, less appetite for loans maybe, tougher to grow deposits compared to peak seasons. It's generally a bit of a harder slog.
Right. So how did AU Small Finance Bank actually do in that kind of weather?
Well, this is where it gets interesting. Despite this system-wide slowdown in credit demand, AU reported, frankly, pretty strong performance.
How so?
The policy environment helped a bit, lower interest rates, plenty of liquidity floating around, upcoming CRR cuts. It's the cash reserve ratio banks have to keep at the central bank.
Okay.
All that supported deposit growth and helped them lower their funding costs, which is, crucial. So they showed some real resilience.
Resilience is a good word. Let's quantify that. The top line numbers. Profit after tax or PATE?
PATE was up 16% year on year, came in at 581 crore for the quarter compared to 581 crore last year.
16% in a muted quarter? That feels significant. Is it just resilience or something more?
I think it points to more. It suggests they're finding ways to operate efficiently, even when the tide isn't lifting all boats. Their net total income think revenue also grew nicely, up 18% year on year to 2,855 crore, again beating the market trend.
Okay.
But here's the kicker for me. Operating profit. PPOP. They call it profit before provisions and tax.
Right.
That saw a huge jump, 38% year on year. It hit 8,312 crore, up from 952 crore.
38%. Wow. Okay, what does that tell you?
That signals serious operational leverage. They're getting much more bang for their buck from their core banking activities, really squeezing efficiency out.
And what about returns? ROA.
Return on assets, ROA, was 1.5% annualized. Return on equity, ROE, was 13.3%. ROE slightly down from 1.6% last year, but ROE actually ticked up slightly from 13.2%. So solid returns.
And for the shareholders directly, EPS, book value.
Yep. Earnings per share grew 15% year on year to 7.8, and book value per share increased 14% to 239. Steady growth there.
So the management's overall take, you said the numbers were strong despite the headwinds.
Their tone was cautiously optimistic, acknowledging the challenges, definitely, but also pointing to this consistent performance track record.
Makes sense. Balancing short-term delivery with that long-term forever bank idea.
Exactly. Not chasing risky growth, focusing on sustainability seems to be the message.
Okay, let's dive deeper then. Deposits the lifeblood, right? You said they outperformed here significantly.
Oh, absolutely. Total deposits hit 1,027,696 crore. That's a massive 31% jump year on year from about 97,000 crore.
31%. And the overall sector grew.
Only about 10.1%.
Yeah.
So, yeah, AAU really pulled in the funds. Even quarter-on-quarter growth was a healthy 2.8%.
That's impressive growth, but did they have to pay up for it? What happened to their cost of funds?
That's the other impressive part. Their cost of funds, the COF, actually decreased, dropped 6 basis points quarter-on-quarter to 7.08%.
Decreased, even while growing deposits that fast.
Yep. And their incremental COF, the cost of new funds coming in, also dropped significantly by 62 basis points, landing at the same 7.08%.
How did they manage that?
They actively cut their peak deposit rates, shaved 50 basis points off savings accounts down to 6.75%, and a hefty 90 basis points off term deposits down to 7.1% compared to where they were in March. Shows they have pricing power.
Smart. What about the quality of those deposits? CASA ratio.
The CASA ratio, current and savings accounts, held stable at 29.2%. which is decent.
Then the overall stability.
When you add in their retail term deposits and non-callable bulk deposits, what they call stable deposits make up 79% of the total. It's a very strong, sticky base, less likely to fly out the door if rates change elsewhere.
Good foundation. And liquidity. Any concerns there?
Nope, seems quite comfortable. Their average liquidity coverage ratio, the LCR, was 123% for the quarter. That's up from 116% the previous quarter, well above the regulatory minimum.
Okay, solid on the funding side. Let's flip to the other side. Lending. How did that huge deposit growth translate into loans, into advances?
The gross loan portfolio, GLP, also grew well, up 18% year-on-year to 1,017,624 crore.
Again, outpacing the sector.
Yeah, the overall banking sector loan growth was only about 9.5%, so AU is growing faster.
But you mentioned a twist earlier in where the growth came from.
Exactly. Here's the nuance. Their secured businesses, think vehicle loans, small business loans backed by collateral, that sort of thing, makes up about 90% of their book.
Right.
That segment grew strongly, up 22% year-on-year. Very healthy.
But
Their unsecured businesses, mainly microfinance, MFI, and credit cards, that part actually shrank. It saw a degrowth of 23% year-on-year.
degrowth, so they pulled back deliberately.
Precisely. They called it a deliberate calibration, a conscious choice to slow down in those unsecured areas likely to manage risk.
Interesting. And the balance between loans and deposits, the CD ratio.
But credit deposit ratio stood at 79% if you exclude some specific refinance advances from institutions like NABARD. That's generally seen as a healthy balance, not overlending relative to their deposit base.
Okay, now this connects to what you said about margins getting interesting. Net interest margin, NIM. It declined, right? Walk us through that.
It did. NIM came down by about 38 basis points quarter-on-quarter, settled at 5.4%. That's compared to 5.8% in Q4 and 6.0% a year ago in Q1 FY25.
A 38 BPS drop sounds like quite a hit. Why did that happen? Was it just the lower cost of funds wasn't enough?
It's more complex than that. It was driven by a few things, and some of it, as we discussed, seemed strategic. First, loan yields dropped by 27 basis points.
Why?
Partly repo rate cuts filtering through, partly that change in the loan mix, less of the higher yielding MFI loans because of that calibration,
Okay.
and also lower yields on credit cards. Second, investment yields were down 25 basis points because interest rates generally fell, plus they booked some treasury gains.
Right.
And then there was about a 10 basis point drag from holding extra liquidity in some mutual fund investments. They expect some of that to reverse later.
Okay, so multiple pressures on the yield side.
Exactly. But that was partly offset by the good news we already talked about, the 6 basis point reduction in their cost of funds.
So NM down, but largely understandable given the strategy and environment. How did other income and expenses look? Did they help cushion the blow?
They definitely did. Other income surged up 59% year-on-year to 811 crore.
Wow, 59%. What drove that?
The report says it was largely aided by higher treasury income, so good timing or skill in their treasury operations. If you strip that out, the core other income was up more modest, but still positive, 4% year-on-year.
Okay, and costs. Were they keeping a lid on expenses?
Seems like it. Operating expenses grew only 4% year-on-year to 1,543 crore. That's pretty disciplined growth.
And the result for efficiency, cost-to-income ratio.
Big improvement there. Cost-to-income ratio dropped to 54.0%. That's way down from 60.8% in the same quarter last year, largely thanks to those treasury gains boosting the income side and the tight leash on costs.
Okay, makes sense. Let's shift to asset quality. NPAs?
Yeah.
Gross and net non-performing assets. You mentioned a slight uptick.
Yes, a marginal increase. Gross NPA rose to 2.47% and net NPA to 0.88%. That's up a bit from 2.28% and 0.74% in the previous quarter, Q4.
Why the increase? Cause for concern.
The bank attributes it mainly to seasonal trends. Q1 can often be a bit weaker for collections after the year-end push. They also specifically mentioned higher slippages loans turning bad in credit cards and some parts of their secured mortgage book down in South India.
Okay, so some specific pockets of stress. How are they provisioned against potential losses?
Their provision coverage ratio, PCR, looks pretty robust. It stands at 83%, though that includes technical write-offs. If you exclude those, it's 65%.
Still decent coverage.
And on top of that, they're holding extra buffers, 41 crore in floating provisions, kind of a general rainy day fund, and another Euro 17 crore in contingency provisions specifically earmarked for the MFI portfolio.
Extra cushions. What about the actual cost of credit for the quarter?
Net credit cost was 0.34% of their average total assets. They did note this was slightly higher than expectations,
Way higher.
linked to what we just discussed. Lower collection efficiency in MFI It dropped slightly from 98.7% to 98.3%, and those slippages in the South India mortgages. They now think the MFI recovery might be pushed out to Q4.
And this ties back to the deliberate pullback in unsecured loans.
Absolutely. The degrowth in MFI and credit cards shows they're actively managing that risk. They acknowledge that credit card asset quality is still elevated, but they believe the stress there is peaking, and it's within their expected range. It's about controlling the exposure.
Okay, stepping back from the quarterly numbers, the bigger picture, the CEO's cautiously optimistic stance and this forever bank vision, how does that translate into strategy?
It seems to be about building something sustainable and broad-based,
Yeah.
deepening customer relationships, expanding their reach smartly, and keeping a really sharp eye on credit quality. They feel they're well-positioned for when the economy eventually picks up more steam.
Any concrete examples of strategic moves they highlighted?
Yeah, quite a few, actually. They bought a new building in BKC, Mumbai's financial hub, to consolidate most of their Mumbai operations. That should boost efficiency.
Makes sense.
On the governance front, they added 2 new independent directors, Mr. Nankumar Saravade and Mr. J.M. Prasad. Brings the board to 12, with a strong majority of 9 independent directors, including 2 women. That looks good.
Strong governance.
I agree.
What else? Licensing, partnerships.
The big one is the potential universal banking license. Their application evaluation by the RBI is apparently in progress. That would be a major step up from being a small finance bank.
Huge implications there.
And partnerships. They've launched a climate risk advisory program with the IFC, the International Finance Corporation, and a strategic tie-up with LIC, Life Insurance Corporation of India, to sell more insurance products,
Yeah.
broadening their offerings.
Interesting mix. Anything focused specifically on customer segments?
Yes, definitely moving up market too. They launched premium concierge services for their high-net-worth clients under the AU Ivy and Eternity brands, plus airport transfers for NRI customers in those segments and the AU Royale category,
Targeting the affluent.
but also focusing internally. They introduced an employee welfare program called House of Growth, especially for their frontline teams, like in microfinance, recognizing the people on the ground.
Good to hear. Now, tech. Crucial for any bank today, let alone a forever bank. How are they doing on the digital front?
They're putting serious money into it, dedicating 8 to 10% of their total operating expenses just to the tech stack.
That's a significant chunk.
It is. And it seems to be paying off in reliability. They boast 99.9% uptime for critical apps. And incredibly, they claim no cyber incidents in the last 8 years.
8 years. That's impressive in today's world.
It really is. Their main customer app, AU0101, seems well adopted too. 3.41 million registered users. That's about 65% of their standalone customer base.
How many are actively using it?
About 1.49 million are monthly active users, so 44% of those registered. And those active users are doing, on average, 8 transactions a month, added up to 7 million financial transactions through the app just in Q1. So it's clearly being used.
Solid digital engagement. But they're still a small finance bank. What about physical reach, especially for financial inclusion?
They haven't abandoned that at all. They have a huge network, over 2,500 banking touchpoints in total. That includes 615 branches and 678 ATMs.
Spread across the country.
Yep, 21 states and 4 union territories. And here's a key stat for inclusion. Almost a third of those touchpoints, 812 locations, are specifically in unbanked rural centers.
Wow, 32% in unbanked areas. That's a serious commitment.
It absolutely demonstrates that commitment to reaching underserved populations. It's a blend. Strong digital platform plus deep physical reach.
And speaking of that commitment, beyond the core banking, the Small Finance Bank name implies a social mission. What about their CSR, their community impact?
It's quite substantial, actually, and seems genuinely embedded. They highlighted several programs, AU Ignite, for example. It's a skills academy in Rajasthan. They've trained over 30,000 young people.
30,000?
Yeah, and linked over 22,400 of them to jobs. Think about the impact providing skills and employment in areas where opportunities might be scarce.
That's life-changing stuff.
Then there's AU Beno Champion, a rural sports program, coaching 5,000 kids across 50-plus locations. And AU Udyogini for women entrepreneurs engaged over 4,200 rural women, helped over 2,600 start their own ventures.
Empowering women, promoting sports. What else?
AU Kartavya covers basic needs. Over 1,100 health camps reaching nearly 71,000 people, providing dry rations to families in need, installing gel banks, basically water access infrastructure, which is critical in many rural areas.
So really grassroots, practical support. How does this connect back to actual financial inclusion? Are they pushing government schemes?
Directly. They're actively supporting key government financial inclusion initiatives. They have over 500,000, 523,800 PM Than Yoshana accounts. Those are the basic no-frills accounts.
Okay.
Nearly 2 million MUDRA loans. Those are small loans for micro enterprises. And almost 4.5 million Shakti accounts, which are designed specifically for women.
Those numbers really show the scale of their financial inclusion efforts.
It demonstrates their walk and the talk on the Small Finance Bank mandate, reaching deep into underserved segments.
Okay, shifting slightly towards the investor perspective.
Hmm.
Stability, reliability. What do the credit rating agencies say?
Good indicators there. Their fixed deposit program has a strong AA plus stable rating from CRISIL.
That's high investment grade.
Yes. And their long-term Tier 2 bonds, which are a form of capital, are rated A-stable by all the major agencies, CRISIL, ICRA, CARE, India Ratings, reflects solid financial health and low-risk perception.
Reassuring for depositors and investors. And finally, they mentioned celebrating 30 years overall, 8 as a bank. Any notable awards or recognition recently?
They picked up quite a few. An APY Annual Award of Ultimate Achiever from the Pension Authority. PFRDA, likely for enrolling people in the Adult Pension Yojana scheme.
Okay, related to inclusion again.
Exactly. Also, Data Excellence Awards from credit bureaus, CRIF, and TransUnion Civil, which speaks to their data management capabilities.
Important for risk and underwriting.
Definitely. And they got recognized by Great Place to Work, named one of India's top 25 best workplaces in BFSI for 2025, and even in the top 50 companies to work for across all sectors in India.
That says a lot about their internal culture.
It does. Suggests they value their employees, which is key for long-term success, and that forever bank idea. Oh, and an IBA CISO award for cybersecurity incident response maturity ties back to that impressive cyber safety record.
Okay, quite a range of accolades. So let's try and wrap this up. We've covered a lot of ground on AU Small Finance Bank's Q1 FY26.
We have strong deposit growth, outpacing the market, loan growth also strong, but with that very deliberate calibration pulling back on unsecured, focusing on secured.
Right. Margins felt some pressure, but largely due to strategic shifts and the interest rate environment, cushioned by good cost control and treasury income.
Asset quality saw a slight seasonal uptick, but seems managed, with decent provisioning and that proactive de-risking in unsecured.
And underpinning it all, significant investments in technology, a vast physical reach, especially in rural areas, and these really substantial community development initiatives.
You really get a sense of them trying to balance immediate performance in a tricky environment with these long-term strategic bets, the universal banking license hopes, the tech, the partnerships, the forever bank culture.
So here's something to think about. You've heard how AU Small Finance Bank navigated this muted period. They balanced caution with investment, core banking, with that social mission.
As the economy changes, maybe picks up, maybe faces new challenges, how much will that deep commitment to digital reach and that grassroots community connection actually differentiate them?
How much does that shape real long-term resilience and success, particularly in a market as dynamic and diverse as India? Is that the key to being a forever bank?
It's worth pondering. Keep exploring how banks blend business with broader impact.
And consider what that forever bank vision really means for the future of banking itself.